Well, welcome back. And this particular module, which will be a fairly short one, we want to talk about what I would really just say is terminology. These are terms that you'll hear, phrases that you'll hear pretty regularly when we talk about options. And you won't hear them with stocks, they don't really apply there, but you'll hear them with options a lot, and it's around the concept of moneyness. And the specific terms that you're going to hear are in the money or out of the money, in the money or out of the money, or at the money. And what those phrases represent is, where is your option strike price relative to the price of the underlying? So let's look at a couple examples and try to explain this. Let's go to our handy dandy options chain. Now, if you remember how to read an options chain, we had a module on that. You can refresh yourself if you don't remember, but it's pretty simple. We have a July 16th date on this particular. We're looking at the options that will expire on July 16th, and this snapshot was taken in April. So there was, well, you can see 81 days. That's what this number in parentheses means until expiration. Currently, Apple is selling at just shy of 135, 134.72. And you'll remember we have calls on the left and we have puts on the right. And I circled this particular option at 135. So that option at 135 is what we would call at the money. And all we're saying by that is it's pretty close to what the stock is currently selling for. The stock's currently selling for 134.72. 135 is the closest we can get it. That's really at the money. Now, when people say at the money, when that phrase is used, it's always going to be a close enough. It's rarely, is Apple going to be selling for exactly 135 and then you exactly buy the 135 option, or you're looking at that. So when you think about at the money, you kind of want to think about what's the closest we can get, or what's relatively close to the underlying. Now, the in the money and out of the money, which we're going to talk about next, are a little more concrete. So let's talk about in the money for a moment. We're going to look at the call options, and let's look at the 120. The 120 call option, it's currently selling for $16.75 or so. The thing about that is, remember, it gives me the right to buy it at 120. So if I owned the 120 call option, I have the right to buy Apple at 120 when it's selling for 135. I could go buy it if I exercise that option today, I could go buy it for 120, sell it for 135, make an instant $15, and that value is concrete. It's built in, which is why you see the price a little above $15, partially because of that, right? The built-in value, it's never going to be below that. And then there's a little extra for time value because there's still 81 days left where it could go up even more. So when I buy something in the money, there's some of that concrete value built into it. And that's called in the money. It means there's built-in money in that option on top of the time value. Now, puts are the exact opposite. Remember, let's take this 150 put. Apple's currently on the market for, let's call it 135, 134.72, close enough. But remember, puts, they don't give me the right to buy, they give me the right to sell. So if I owned a 150 put, I have the right to sell Apple at 150, but I could buy it today at 135. So again, I have $15 built into that of concrete value, which is why, again, you see that option selling for a little more than that, because there's still time value. So anything that's in the money. And by the way, Thinkorswim and most option platforms do this. They shade or they somehow indicate your in the money and out of the money options in the way that they display them. They use this shading that you see on Thinkorswim. But you'll usually see something like that makes it really easy to identify your in the money and your out of the money options. So anything that's in the money, though, has this concrete value built into it. Anything that's out of the money doesn't. So let's take this, go back to our call options. Let's say I had a 140. Okay, Well, the 140, which is currently selling, just shy of $5, what that says is I have the right to buy it at 140, but I could only turn around and sell it for less for right now, 135. So there's no concrete value built into that. I'm paying that $5 because I'm hoping in the next 81 days, I believe it's going to go above that and that it's going to have some value built into it. And so anything that's out of the money represents just time value. You're just paying for the right to control it for that period of time, which is why you see some of these things that are way out of the money, like look at some of these put options, they're literally selling for pennies, just a penny or 2 pennies or 3 pennies, because nobody really believes, the market as a whole doesn't really believe it's going to get to that level. So as you get further and further out of the money, it becomes less likely we're going to get there in 81 days, and so the value goes down. Same thing would be true on your call option side. As you get further out of the money, it becomes less likely that we're going to get there in 81 days, and therefore the price is lower. So that's it, really. That's your basic concepts of in the money, at the money, out of the money. It's pretty simple, but I really wanted to cover that terminology because it's something you will hear over and over again. All right, we'll see you in the next module.